Hi guys, welcome back to Father and Son Investing. Today we're going to be talking about the disadvantages of dividend paying stocks. Now don't get me wrong, I am not a dividend hater. In fact, I have many stocks that pay dividends. But it is important to know up front before you buy that there are some fallacies or some misconceptions out there about dividend paying stocks or things that people just might not understand about dividend paying stocks and how they're treated. So while there are many more of these to discuss than I am capable of in an 8-minute video, we're going to just touch on 4 of these today. So the first thing that we'll discuss is that dividends are not free money. After that, I'm going to talk about how a high dividend yield may not necessarily be a good thing. I want to talk about that dividends are not safe or guaranteed. And then lastly, we're going to talk about taxes and dividends. All right, item number 1, dividends are not free money. To illustrate this point, I'm going to use a company that I own, Coca-Cola. The ticker symbol is KO. Currently, it's $62.64 a share. We're going to look at some of the data here that's going to help us out. The first thing we'll notice is it says ex-dividend date was June 14th, 2022. If you're not familiar with ex-dividend date, that is the date that you have to own a share of Coca-Cola before that date in order to receive the dividend. Now I want to take you to this little screen here on the Yahoo Finance page, the historical data. What this will show you is the opening and closing prices of Coca-Cola, and we'll see that it's been doing pretty well. But we'll come back here to June 14th, the ex-dividend date. It was 44 cents was the dividend, 44 cents per share. And if we look on the day right before that ex-dividend date, we're going to see something here. We'll see that the opening price was $60.75. The closing price was $61.34. Now this column right here, the heading has disappeared, but this says adjusted close. And if we look at the adjusted close the day before the ex-dividend date, you'll notice that it is 44 cents difference, the closing price and the adjusted closing price. What happened there? When the dividend was declared, the stock price comes down by the amount of the dividend, 44 cents. So when I say that dividends are not free money, while you're getting that payment, the value of your stock goes down by an equal amount. All right, let's talk about item number 2. A high dividend yield may not necessarily be a good thing. To illustrate this point, I'm also going to use a stock that I hold on track. It's their preferred share, so it's OTRKP. It's currently going for $3.07 per share. And if you look down here at the forward dividend yield, you'll see that it says 74.45%. You might be thinking, oh my goodness, that is fantastic. Let's all run out and buy OTRKP. However, what you'll see if you look further into the history of this preferred shares is that its stock price has been plummeting. In June of 2021, it was way up here at almost $25 per share. This preferred share is redeemable by the company at $25 per share, so it was almost at its par value. Now it's all the way down to $3.07. So why is this preferred share price falling so low if it has this dividend yield? Well, on track, its company, OTRK is the ticker symbol for on track, is suffering mightily with loss of numerous customers, decreased revenue, and therefore share price. But there's another reason why a high dividend yield might not always be a good thing. When a company has earnings, there's several things that they can do with those earnings. They can pay a dividend if they want to. They could buy back shares. That, of course, keeps share price up and can elevate the price of the stock as there are fewer shares available. They can use it to pay down debt. And they can make an acquisition, or they can simply retain it as cash. So given those 5 things that a company can do with their earnings, if we see a company that has a high dividend yield, that could indicate that the people who are running that business are not really seeing opportunities for growth out there, and thus are returning some of their earnings as a dividend. Not always, but it's something to keep in mind. Now let's get to the third point. Dividends are not necessarily safe or guaranteed. Remember, I said that there are 5 things that a company can do with its earnings. Of course, one of those is pay out a dividend. This is an article that appeared in the Wall Street Journal in January of this year. The title says, Investors Gobble Up Dividend Stocks During Market Turbulence. I'm going to move down here to this paragraph. It says investors could lose their taste for dividend-paying companies if they cut payouts amid deteriorating economic conditions. It goes on to say that last year, so 2021, there were 372 increases in dividends and 5 cuts. However, let's move back to 2020, the year of the pandemic, well, at least initiation of the pandemic, and we'll see that there were only 298 increases or initiations in a dividend and 69 cuts or suspensions. So just know that during volatile times, particularly when interest rates are rising and companies are trying to meet extra costs associated with inflation, that the dividend might not be guaranteed or safe. If you're investing in a company strictly for its dividend, you need to keep that in mind. All right, the last thing that I want to talk about, number 4, has to do with taxes and dividends. Now, depending on where you live in the world, your dividend may get taxed at different rates or not taxed at all. So I live in the United States. I'll talk about it from a United States perspective, but you'll want to check into how your local government is going to treat a dividend in terms of taxes. So in the United States, when a company pays a dividend, Uncle Sam, the United States government, wants to take a little piece of that dividend. It's a little bit remarkable because corporate earnings are already taxed, and then those earnings which get returned as a dividend also get taxed. Nevertheless, it's important to know that when a company sends out that dividend, the government is going to want to take a piece of that. So that could raise your taxes for the year or potentially even put you into another tax bracket depending on how much of a dividend one is getting. Now that is very different from companies that aren't paying dividends, and although they're having appreciation, capital appreciation there until you actually sell those shares, there's no taxes on that. Now there is a way to get around these dividend taxes, and that of course is to hold your shares of a dividend-paying company or ETF within a non-taxable or a tax-deferred account. So actually the best place to hold them is a Roth IRA. If you're not familiar with those, I have another video about Roth IRAs, particularly for teenagers. All right, that's what I have for you today. Just those 4 things that you need to know about dividend-paying stocks, preferably before you buy them. Nevertheless, if you're learning this after you've already bought them, that's okay too. Now, in that third point, remember I said that a dividend isn't always safe or guaranteed, and at times when companies are stressed, they may suspend their dividends. Certainly, inflation is a time when companies can be stressed, and so that's going to lead me to the next video, which is how do dividend-paying stocks perform in a high-interest rate environment? If this information today was helpful for you, I hope you'll go ahead and give us a thumbs up, and we'd love to have you as a subscriber. And as always, until next time, enjoy your investing.